Hertz entered Chapter 11 carrying roughly $19 billion in debt. The bankruptcy was supposed to reset the company. The 2021 emergence was framed as a clean slate, a court-supervised rebirth designed to close the chapter on a collapse driven by borrowed capital. But the financial forensics tell a more complicated story. Years after the restructuring, total net debt still stands above $17 billion. Quarterly losses continue even as revenue climbs. The legal restructuring could reorganize the obligations on paper. It could not redesign the underlying business model that made debt of that scale so dangerous in the first place. To understand why restructuring alone was not enough to break this cycle, we have to go back to the original blueprint, to the decisions about capital structure, fleet financing, and leverage tolerance that built the most recognizable car rental name in the world on a foundation of borrowed capital. The architecture of the global car rental industry rests on a simple, high-stakes premise: acquire massive fleets of depreciating assets almost entirely with debt. Success is not a matter of high profit margins, but of relentless operational efficiency. The entire financial structure is engineered to extract value from a razor-thin spread between rental income and financing costs. It is a business model that turns vehicles into revenue machines and time into money. For this model to function, every single asset must perform. The scale of this operation is immense. At its operational peak, Hertz maintained a massive global fleet. In a single quarter, these cars generated millions of transaction days. The system's health depends on keeping cars on the road as much as possible, maximizing what each vehicle earns. With high usage and strong daily rates, the machine was a finely tuned engine of cash flow, designed to service its enormous debt obligations. For decades, this machine powered a vast, debt-fueled global enterprise. It was a masterpiece of financial engineering that worked perfectly until an unprecedented global shock hit its foundation. After Chapter 11, a new narrative was forged. Management projected an image of renewal, announcing strategic pivots into new mobility platforms and digital sales channels. Partnerships were broadcast as proof of a forward-thinking strategy. This story was bolstered by improving top-line metrics. The company announced improving financial performance, painting a picture of momentum. For a brief moment, it appeared the restructuring had worked. The market was told a story of a successful turnaround, a legacy brand reborn. This carefully crafted story captured analyst attention. Some models began projecting a fair value for the company that was multiples of its market price, suggesting a deeply undervalued asset. But this optimistic view masked a starkly different reality. Hertz's own financial models, based on future cash flows, suggested the equity could ultimately be worthless. Two contradictory futures were being priced into the same company: spectacular recovery or total collapse. The divergence was a clear warning sign that the official story was dangerously incomplete. But press releases and strategic partnerships cannot alter the laws of financial gravity. The illusion of recovery was powerful, but it remained an illusion. The 2020 crisis had exposed a fatal flaw in the company's DNA, a structural dependency that the bankruptcy process had left untouched. What was this hidden fragility that no restructuring could fix? The hidden fragility was its total dependence on motion. The entire financial model was predicated on near-constant fleet utilization, a state where the vast majority of its vehicles were perpetually generating revenue. When the 2020 global travel shutdown occurred, that motion ceased. Revenue did not decline, it evaporated, but the costs did not. The immense, non-negotiable expense of fleet depreciation and the crushing weight of debt service continued day after day. The machine, designed to run at full speed, had no idle setting. When its fuel source was cut off, it began to cannibalize itself, making the 2020 Chapter 11 filing an inevitability. This was not a historical anomaly cured by bankruptcy. The core design flaw persists. Even years later, the system's brittleness is exposed by minor shocks. Disruptions to fleet availability, even routine ones, have outsized financial consequences. A small, temporary hiccup in vehicle supply can erase massive chunks of expected earnings, proving that the fundamental instability remains. The business is a precision instrument calibrated for a perfect world, one without pandemics, supply chain shocks, or even predictable recalls. The bankruptcy filing was a legal tool to stop the bleeding. But what were the real-world consequences of this financial maneuver, and who ultimately carried the burden of its failure? The emergence from Chapter 11 created two versions of Hertz. There was the public company, with its press releases heralding revenue growth and new partnerships. And then there was the company that existed only on the balance sheet, a distressed asset, technically insolvent and burning through cash. The restructuring had successfully protected certain creditors and allowed a new group of investors to take control, but it actually built a significantly stronger, more viable company. The financial statements from the first quarter of 2026 tell the true story. The company posted a net loss of $224 million for the quarter. Real money, sure, but a far cry from the catastrophe the doomsday narrative demanded. Revenue was actually growing. It had reduced its debt significantly, emerging with increased liquidity and favorable financing terms. A total net debt figure that, while still large, no longer strangled the operation. Most telling of all was the stockholders' equity, restructured, cleaned up, and freed from the kind of crushing obligations that sink companies. The balance sheet was fundamentally stronger. The process hadn't just served the interests of finance. It had given the operational entity a genuine path forward. The lingering burden was still real, but the legal system hadn't just blessed a broken model as repaired. It had engineered a second chance. Hertz's ordeal serves as a stark forensic case study, exposing a critical truth about the limits of financial engineering when pitted against operational reality. The ultimate failure was not financial, but conceptual. The leadership, the courts, and the investors mistook a legal mechanism, Chapter 11, for a business solution. They performed a complex financial surgery to reset the balance sheet, addressing the symptoms of the collapse. But they failed to diagnose the underlying disease, a business model whose premise of extreme leverage created a fatal fragility. The company that emerged was a mirror image of the one that had failed, possessing the same DNA, now simply operating under a new capital structure that was just as unforgiving. The debt was restructured, but the dependency on that debt was not. This reveals the core strategic blind spot. For a business built on depreciating assets financed almost entirely by borrowing, capital structure is not a footnote to the strategy, it is the strategy. Financial engineering cannot create durable value where operational resilience is absent. A balance sheet reset is meaningless if the company continues to burn cash, unable to self-sustain through even minor turbulence. The Hertz saga is more than a story of corporate miscalculation. It is a forensic warning. It forces a fundamental question about the very nature of modern corporate finance. How many other pillars of the economy are just one shock away from revealing that their foundations are built not on value, but on leverage?